Hello, and welcome to Connected With Latham, where we discuss ideas, legal developments, and business trends shaping the global economy. I'm Tom Evans, a private equity M&A partner in Latham & Watkins' London office. In this episode, we discuss the vital role of undrawn revolving credit facilities, or RCFs, for private equity portfolio companies and how the market is likely to adapt to provide for this essential component of the capital structure. I'm joined today by a fellow partner from the London office, Francesco Lione. Francesco represents private equity firms, investment banks, and corporate clients in a wide array of international financing transactions and brings terrific insight on today's topic. Thank you very much for joining us, Francesco.
Of course, I'm very happy to be here, Tom.
Right, let's get started. So I'm interested to talk to you about the article you co-authored in PE Views. Could PE benefit from the universal adoption of super senior RCFs in leveraged financings? In the article, you talk about how undrawn RCFs are essential to private equity portfolio companies and, more specifically, how the COVID-19 pandemic has affected the market. Can you kick off by giving us an overview of why undrawn RCFs are a hot topic?
Happy to. Undrawn RCFs are essential to portfolio companies for three main reasons. First of all, they act as a backup in case of mismatches in the working capital cycle. Second, they provide comfort for a rainy day. And third, they preserve swift access to deal making when other financing sources are unavailable or less easily accessible, such as in the current market conditions. If I take you back to the first few weeks after the pandemic hit in 2020, you'll remember that when people went into lockdown and global demand stalled, businesses all around the world struggled to remain liquid.
Yeah, I remember those conversations, Francesco.
Well, it was exactly in that type of environment that undrawn RCFs came to the fore as an essential parachute. It was a time when leveraged companies dashed for cash, and CFOs started drawing revolving lines to provide for a cushion of liquidity.
I recall having discussions with many CFOs, Francesco, at that point, around the terms on which RCFs could be drawn and where the proceeds should be warehoused pending potential use. Following on from the focus on RCFs during the first part of 2020, what is the current state of supply and demand as far as RCFs are concerned, Francesco?
Well, banks are the primary, if not the exclusive source of RCF commitments. But the product commands very tight pricing in the market and is not profitable on a standalone basis. So banks tend not to view it as a compelling use of their capital. Instead, they treat RCFs as relationship-driven transactions that grant access to other types of borrower business, such as capital markets activities and M&A advisory work.
Got it. So there's an imbalance between supply and demand in the market, Francesco. Is that something that Dealmakers are aware of?
In short, the answer is yes, Tom. Dealmakers are very well aware of the imbalance between high demand for RCFs from private equity clients and short supply by banks. And indeed, sponsors often request a turn of leverage or more in RCF commitments at the outset of deals, but then often see their demand quickly cut down to a fraction of that initial ask by the bank's underwriting syndicates.
So what's been the market response to that, Francesco?
Using economic common sense and theory, the cure would be for the pricing of RCFs to rise to rebalance the gap in demand and supply. But that would be unattractive to private equity and futile for banks. Banks are accustomed to treating the product as a loss leader and are primarily preoccupied by the constraint that undrawn credit lines place on their ability to lend and churn capital profitably elsewhere.
So not an ideal solution for banks. What other technology then exists to attract lenders for portfolio company RCFs, Francesco?
There is an alternative option. We think that one way to boost RCF's appeal to banks would be to make RCFs less onerous to carry on their balance sheets. And that could really make them more attractive and induce banks to provide that type of lending commitment more freely.
So that's significant. How are sponsors going to make that happen?
Private equity could achieve that goal by elevating the ranking of RCFs to super senior status in all private equity financings, including financings with loans, not just deals that have bonds in their capital structure. The key argument that we made in our piece is that with a substantial convergence in the investor base and covenant terms across bonds and loans, the enduring difference in the status of RCFs, which rank super senior when they're paired with bonds, but rank pari passu when they're paired with loans, has become anachronistic, a vestige of the past. Altice, to name a notable example, is one case where the RCF has retained its super senior status despite its cohabitation with loans in the same capital structure.
Interesting, Altice. So in terms of the super senior ranking, how tested is that approach? How are super senior RCFs and pari passu RCFs faring in recent restructurings, for example, Francesco?
We just came out of a wave of distress originating with the pandemic. And what we saw is that super senior RCFs are rarely impaired, even when the term loan creditors face substantial write-offs. Banks that hold pari passu RCF commitments, on the other hand, are not faring so well because they have to, and often do, end up with the same scaling down of claims as any other senior secured creditor. So there's a clear difference in recovery outcomes, and that difference explains why banks apply a more lenient capital charge to super senior RCFs and why their credit committees tend to have fewer reservations when they have to book super senior RCF commitments.
Interesting. So I want to dig into another part of your article, Francesco, where you talked about balancing risks and rewards. How is the mainstream market reacting to super senior RCFs, and how do you see this panning out in the coming months?
The new capital structure we're hypothesizing, in which super senior RCFs would coexist with term loans, hasn't yet been adopted in PE transactions. It is, however, widely used in private debt transactions, and occasionally we see it in the mainstream leverage finance market too, such as in the Altice example we talked about a moment ago. Interestingly, we're now working on a new PE financing where we had a similar conversation with the debt advisor at the outset of the deal, and we're now exploring a super senior RCFs alongside a syndicated term loan B. We'll see how that pans out. Broader market acceptance likely will involve execution challenges, including some heavier involvement from the lead banks in a few initial loan syndications as loan investors start digesting the proposal. But it's worth noting that the new transaction structure would be mutually advantageous for private equity and banks. Sponsors might get more of what they want, that is, reliable sources of liquidity at a lower price. And banks may become more generous in extending RCF credit when they know that they can rely on super senior security.
And looking forward then, Francesco, as we see RCFs or super senior RCFs being taken out, what issues do we foresee as these become more prevalent in the market?
It's hard to predict, but when we look at recent examples, including Altice and the many deals in the unitranche market, one could imagine that acceptance of the new capital structure may wind up being more of an anticlimax than a cliffhanger. In particular, if the amount of super senior debt introduced in the new capital structure does not tip credit rating outcomes in the wrong direction or exceed investment limits of CLOs, we really shouldn't expect any objection in principle to the proposal.
I see. It sounds like we may need to get you back on the podcast soon for an update, Francesco. As always, it's been brilliant talking with you, this time about the benefits to PE of universal adoption of super senior RCFs in leveraged financings.
Delighted to be here with you. A pleasure as always. Thank you for inviting me.
And thank you for listening to this episode in our Connected with Latham podcast series. You can subscribe and listen to new and archived episodes of Latham's podcasts on lw.com, Apple Podcasts, Google Podcasts, Spotify, or wherever you get your podcasts. If you'd like more information about the topics in this podcast, please email us from the links located in the show description. We hope you'll join us again next time.
This podcast is provided as a service of Latham & Watkins LLP. Listening to this podcast does not create an attorney-client relationship between you and Latham & Watkins LLP, and you should not send confidential information to Latham & Watkins LLP. While we make every effort to assure that the content of this podcast is accurate, comprehensive, and current, we do not warrant or guarantee any of those things. and you may not rely on this podcast as a substitute for legal research and/or consulting a qualified attorney. Listening to this podcast is not a substitute for engaging a lawyer to advise you on your individual needs. Should you require legal advice on the issues covered in this podcast, please consult a qualified attorney. Under New York's Code of Professional Responsibility, portions of this communication contain attorney advertising. Prior results do not guarantee a similar outcome. Results depend upon a variety of factors unique to each representation. Please direct all inquiries regarding the conduct of Latham & Watkins attorneys under the New York's disciplinary rules to Latham & Watkins, LLP, 1271 Avenue of the Americas, New York, New York, 10020. Phone number 1-212-906-1200.